Next, we'll jump on to the next topic here. One with regards to portfolio yield expectations. In the last year in Canada and the US where we do business, the Fed bank rate has increased significantly, by about 4%, throughout the course of last year. One question that comes from clients is, can we expect 4% higher return? And the simple answer is definitely no. But, I think there's a few topics of discussion here, which can kind of give people at least, somewhat of an answer. First is, last year we made a conscious effort to renew a lot of existing client loans, ones that have been on the books, sometimes for a number of years. Tammy, maybe you're best to talk a little bit about those, since you dealt with a lot of those existing clients that we did renew, and talk about kind of the philosophy on why we like that as opposed to putting a new loan on the books. And we actually had to take a yield haircut on some of them as well. So maybe just briefly talk about that to start.
Sure. Well, I'm a big proponent of retaining the client where it makes sense and where it's appropriate for us. As Erica described, the number of BDOs and the work that they do to bring a client in, talk about, taking 629 frogs and turning them into 45 new transactions, right? I mean, that's a lot of work. So there's a lot of acquisition costs that goes into getting those clients and bringing them on the books. If you have a good client that's doing the things that they said they would do, where they're appreciative of the business and flexibility and opportunities that we allow them to take on, then I think it's worthwhile to try and retain that client. Often, I mean, we talk about, when it's renewal time, it's not like we automatically assume that we'll just keep the business and roll on. Our clients are smart. They're going out to, whether they're doing it through a broker or whether they're doing it on their own, they're going out to the market and seeing what they can get, right? Whether that's service, whether it's size of facility, whether it's structure, or whether it's cost. And we bring they bring that back to us. And we're always seeking to win the business in the places where we think it's appropriate. And sometimes it means you need to give a little bit on rate to retain the business, because you understand the client, you're happy with the collateral, they're performing in the way that you want them to. So it's worthwhile. And we've, frankly, to me, that's a win. And over the past couple of years, we've been able to do that with some pretty significant clients, where I think it's made good sense from a risk and reward perspective.
Yeah, great. Erica, since you work a lot with the team on all the new loan opportunities, I mentioned that the bank rates have gone up by 4%. For new loan opportunity, we talked about existing clients that it's kind of the devil, it's the comfort there, and companies we know extremely well. But what about new companies? A typical deal that we might have put out at 11% interest rate 12 or 18 months ago. Can we? We're just not able to put that out at 15% at this point. Correct?
Yeah, correct. Competition is a very big factor right now when it comes to establishing rates, right? Which again plays into that luxury of choice, right? The more you're looking at, then you can kind of find the opportunities where you can get the yield that you need to get. You don't have to cut your rate so much that you're either breaking even or booking a loan at a loss. So you're able to sort of weed through to find the ones where you can obtain an appropriate yield for the risk. There's so many factors. What's the risk factor of this deal? What can I win it at? What are my competitors coming in at? There's so much at play here. So, right now we're in the, I would say 13 to 14 space is what we're looking at, because what you would previously see in a 12% opportunity, you're just not seeing, right? And again, we're not going to sacrifice our credit quality, our credit box, our credit policies in order to book something. We're going to find the ones that we want to book and issue loans to, and we're going to stick firm to what we think our yield needs to be. Every now and then, we might cut yield if there's a strategic opportunity, specifically when we're looking at lender finance transactions, right? When you have another factoring company as your client, there is an immediate synergy with them because they're generally smaller than we are. So they're going to source opportunities that are too large for them. And that will create more instances of more looks, more opportunities for us. So it just adds another facet to look at. So every opportunity that we're looking at, we're pricing according to what we see. But really right now, pricing is definitely a factor when it comes to competition, for sure. For sure.
So a little bit of a biased increase, but definitely not 400 beeps. And I know that there's been a mindset within the, collective teams of, with what's been going on in the marketplace over the past year to, err on the side of caution as well. So that has restricted it. The last I ran portfolio gross yield recently, we are a little bit higher than we were about 14, 15 months ago, but not materially higher. My guess would be, and based on some new deals that I've seen coming through the system, Erica, I know we the three of us talked about some new term sheets that we have out that are at rates definitely higher than the gross yield of our portfolio by a fair amount. So, I think as things work themselves through the system, I think we might get a bias towards a little bit higher within the portfolio, but definitely don't expect a 200 or 400 basis point increase from our gross yields in the portfolio. We're definitely not seeing that, nor are we, but it's also a bias that we're taking on staying with existing clients as well as for security and erring on the side of caution.